Welcome, everybody. It's time to start cruising into a better financial future with your host, Kim Cruz. Hey, everybody. Welcome to Cruising into a Better Financial Future with Kim Cruz and Adam Strum. I'm your co host, Adam Strum, but our amazing host for the day, Kim Cruz.
Thank you so much, Adam. I am Kim Cruz. I am a wife, a mom, a daughter, sister, friend, and entrepreneur. And I am the proud business owner of Cruz Credit Consulting, but not necessarily in that order. I have over 30 years experience in corporate America and a passion for helping people succeed in all areas of their life. As mentioned, I'm joined by my friend Adam Strum. He's the brains behind the production. He is a owner of Financial Rescuers and co-owner of U.S. Financial Alliance and a 20-year veteran of helping people get out of debt and improve their financial health. Together, we review our clients' problems and address them with our experience, tips, tricks, and resources of network referrals to help you cruise into a better financial future. Adam?
I'm Adam Strum. I have a history of working in corporate America, and in 2008, at the financial collapse, I opened my first debt relief company, and I've worked in debt and finance and credit ever since. I've worked for some of the biggest names, including National Debt Relief, but my most popular was Financial Rescuers, which I owned and operated. We operated for over 5 years without a single complaint in an industry where complaints run rampant. So I'm looking forward to giving out educational tips and tricks and, of course, educating everyone on how to cruise into a better financial future.
And I am so excited about our topic today. Our topic is credit, right?
I've heard of it.
So many of my clients ask about credit, and the bottom line is, this isn't something that's taught in school. Financial literacy is a huge problem in our country, and that's why 62 million Americans have a FICO score of less than 599. And there's so much that we can teach on it. We could probably take a whole week's worth of segments to cover everything, but we're going to touch on the basics today, just to give our audience a guide to credit, right?
Makes sense to me. In addition, we're even skipping our usual mailbag item where I throw out an article of the week. We're going to skip that because we want people to focus just on credit today and learning the basics so that they'll understand all our future podcasts.
Exactly. Yep. So we're going to dive right in, and I'm going to start with one of the questions that my clients ask me the most, and it's real basic, but it has such a wide answer. The question is, what is a credit score?
Okay. That has multiple answers, to be honest with you. A credit score mainly, though, is the way the financial industry decides just how credit worthy you are. So when making up their minds whether to give you a loan, a line of credit, when they're trying to make up their minds as to whether or not you're a good risk for any type of financial endeavor, they look at this credit score. And there are several different scoring models to provide a credit score. The most popular is FICO, Fair Isaac Credit Scoring. The FICO score is the mainstay throughout the industry, but each one of the three major credit bureaus, TransUnion, Experian, and Equifax, uses their own version of a FICO score.
Mm-hmm. And you know, most people think that their credit score is also based off of their income, and income isn't even part of a credit score, right?
Well, it isn't directly. It is indirectly part of a credit score. Directly, it has nothing. It's not plugged into the equation. However, having a very high income can cause factors that are figured in to be in your favor. So, for instance, we can use rich lady A. Rich lady A has an income of $200,000 a year. She's more likely, because of her value, because of the amount coming in, to have her bills paid on time. She's more likely to be a better credit risk for a lot of different. I don't want to get into all the little minutia, But basically, she's going to probably have a more steady baseline. At her lowest, it'll be around 620, whereas the person who makes $40,000 a year will probably have a baseline around 580. And they can work it up to 800 from there. It's very possible for someone who makes 10 grand a year to have an 800 credit score. I know people like that. And it's also possible for billionaires to have a 425 credit score. So, I mean, there's no bank on earth, and this has been widely reported by every major news outlet. So it's not a political thing. It's just a fact. No bank will touch Donald Trump. And it's because his credit is not worthy anymore. He's leveraged. It doesn't mean he's broke, and it doesn't mean he's a bad person. It just means he's over leveraged, that the amount they value him at is already overspent.
Mm-hmm. And you bring up a lot of really good points that we can touch on, that your credit score doesn't define you. And
oh, please never ever take a credit score and judge a person by their score. It is a completely bad way to judge someone. Some of the greatest people in the world have had horrible. Albert Einstein had a horrible credit score. Okay, some of the smartest people we've ever seen can have horrible credit scores. It's really important to understand, and I'm sure we're going to get into this in the next couple of questions because that's where this goes. The entire credit scoring system sets up the general public for failure.
Mm-hmm. Yeah, and you and I have had numerous conversations about that and the clients that we encounter, and how we help them turn their life around, really, by helping them fix their credit score. And the whole point of this is to help people understand credit. So the next question actually was received from Chantel in California, and she asked, how is a credit score calculated? And before we get into answering that question, I know that is such a funny question for you and I, being in the credit industry, but I once made a phone call to one of the credit bureaus with my son because he had an error on his credit report, and we didn't know at that time how to fix it. And very nice lady on the phone, but we asked her, why did his credit score drop so much? And she said, because the system calculated his credit score. I said, okay, what caused that to drop? She couldn't answer it. She worked for the credit bureau and could not answer how the credit score was calculated. So there's this hidden secret that spits out a credit score, and that's how it's calculated. So, but we know what goes into the credit score, but I'll let you start off.
Do you ever notice that when you're on Facebook and somebody you're talking to in the room, and you're just on there, commenting, but you're talking to a friend in the house with you, or your husband or one of your kids, and you say, we need a new toaster oven, and then the next thing you see as you scroll down is an ad for a toaster oven?
Is that amazing?
No, that's an algorithm. That's what that is.
Yeah.
And an algorithm is simply a mathematical equation that is forever changing based on hundreds of different factors. Mm-hmm. And your credit score is an algorithm. It's not a set in stone calculation. There is no set in stone calculation. What is calculated Monday can be calculated differently Tuesday, Wednesday, Thursday, Friday, can be calculated differently after 2 p.m. each of those 2 days. The algorithm is forever changing and adapting. And because it's forever changing and adapting, the poor woman that you asked that question of, that knew she should have known the answer, but knows that there's impossible for her to know the answer, can't tell you why.
Exactly.
And that's the answer to that question. Your credit score is calculated based on several major factors. The number one factor is a two-pronged thing called utilization. Mm-hmm. Utilization is not one thing. It's two completely different things. It's how much of your available credit you're using, utilization, and it's how much credit you can get, is also utilization. So how much credit are you eligible for, even though you may not have it? So those two things comprise utilization, and that makes up more than 1/3 of your total credit score.
Exactly. Yep. And we talk about the algorithms, but we do know 5 factors, and credit utilization being one of them.
Being the number one factor. Mm-hmm. You should always try to keep Your balances on your credit lines, whether it's loans or credit cards, doesn't matter. Even a mortgage, believe it or not, you should always, you'll do better on the back end of your mortgage credit wise than you do on the front end. And that makes sense because you've had it for so long. You should be more credit worthy if you get to the back end of your mortgage. But the more your balance goes down for the amount of credit you've been given, the better your score gets. So if I have a $10,000 Chase card and I'm using $8,000 of it, my score will go down because I'm utilizing too much of the available credit. But if I'm utilizing 2,000 of it, my score will go up. Even though I have $2,000 of outstanding debt, my score goes up because I'm utilizing a percentage below 33.33%.
Right. And it all depends on when your credit score is pulled, because you could be using 30% and trying to maintain that 30% by using your card, paying it off, using your card, paying it off. And if they pull your credit right after you've used it, that's going to bring your score down. So
it is amazing to know that the time of day, day of the week, and day of the month that they do the calculation can affect your score by up to 20 points. And the very next day, if they did it again, you'd have 20 more points on your credit. So you have to remember this. When you're building your credit up, you want to build it with a cushion.
Mhm.
So if your goal is to get to the ever elusive 750 credit score, which is the start of excellent credit, that's where excellent credit begins, at 750. Everything from 750 to 900, which is a perfect credit score, which I believe there may be 2 or 3 people in the entire US that have a 900, but even they fluctuate. On any given day, it might be 870, 860, 850. Here's something to remember about credit scores. Like taxes, they're in blocks. So if I have a 685 or a 705, who has the better credit score? Neither of us. We're identical in the eyes of lenders.
Right. Right. And people think because, well, I have a 705 and you have a 680, that's not the case. And there's so many different factors that
680,
lenders
by the
look.
way, is one of those cutoff points.
Yeah.
So real simple, very, very quick overview here. And this is different in every industry. So what I'm saying is not the same across every single industry, but generally speaking, bad credit is anything under 580. Bad fair credit, where you can still get loans, is 580 to 640. From 640 to 680 is fair credit. It's a very small window. Fair credit means that there are a number of lenders that will gladly work with you. However, for major purchases, a home, a car, you're going to get disadvantaged in rate. Your interest rates will be higher. Once you go over 680, you start to enter good credit. 680 to 720. It's only a 40-point window. The windows are small. You're in the good credit. Now, to get good plus, you need to be over 750. Anytime you're over 750, you're in good plus. To get to excellent, you want to hit 800. And that's just generalized.
And again, that brings up another point about having good credit, because your credit score affects what you pay for anything that you finance. And the difference between somebody purchasing a vehicle and having a 580 credit score compared to somebody that has a 750 credit score, they're going to be, the lower credit score is going to be paying $13,000 more in interest
over the life of the loan.
Over the life of the loan. Exactly. And that's why
not only that, but it's disadvantaged. My partner at USFA, US Financial Alliance, Isa Israel, and I, we do a little act when we visit companies and we visit educational places to teach credit to people. We do this little act to explain just how backwards our credit system can work. And we have a third person from the audience help us by being the dealership credit person. You know, the finance guy at your local car dealership. Now, we preface it with Isa makes $100,000 a year. And Isa has almost no expenses. He owns his home outright. That $100,000 a year is because he chooses not to work, basically. If he were to actually put in hours, he'd make $500,000 a year. But he's just cruising through life. You know, like we're cruising into a better financial future. He's just cruising through life.
Okay.
Me, I make $40,000 a year. I have to work 60 hours a week to do it. I never see my family. The only way to get to work is by car. I live in rural America. There's no bus that can get me where I'm going. I'd have to ask a neighbor to drive me to the bus depot if I wanted to take a bus to my
Mhm.
job. I depend on my car for everything. Isa, however, has a 780 or 790 credit score, and I have a 640 credit score. And we walk into the dealership. Here's what ends up happening. I must have the car to do my work. My credit's not bad, but it's also not great. It's
Mhm.
average.
Right.
They're going to tell me for my new Toyota Camry that I need to put $2,000 down to get the loan, that I can't drive the car off the lot the same day, that I have to come back and pick it up in 2 days after I'm approved, that I'm going to have to pay 9 or 10% interest over a 5-year loan. And they're going to treat me in that fashion.
Mhm.
Isa shows up at the dealership with $26,000 literally sitting in his pocket. He's ready to buy the car outright. He has the cash to literally buy the car the way you and I walk into Walgreens and buy a can of hairspray.
Mhm. Yep.
But they say, no, 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 please don't give us any money. In fact, we're going to give you 5 years at 0% interest because you already have a lot of money. So we're not going to make any money on you. We're making it on Adam, who works his ass off for 40,000 a year. We're going to make all our money off of him. We're not going to make any money at all on you, sir, because you already make a lot of money. We're going to give you the car with no down payment, 0% interest for 5 years. You can drive it home in 10 minutes. Just let our guys get it ready for you. Okay.
Mhm.
That's disparaging, and it's completely backwards. See,
Exactly.
I'm willing to work hard and pay my loan. I'm the backbone of what makes the economy work.
Mhm.
Isa is far from that in this scenario.
Mhm.
In this scenario, Isa's somewhat of what we call spoiled. And
Mhm.
it's not his fault, it's just the way the system works.
Right.
They reward people who don't need the rewards, and they disparage people who don't need to be disparaged.
Mhm.
I need the break. I need that 0%. It would make people who have a 640 and earn $40,000 a year are at the low end of the middle class. Half of American households in that situation don't own a vehicle
Mhm.
because it's a real hard thing to do to keep up with those payments. My payment is going to be higher because I have a 10% interest rate than Isa's payment would be for his financing with 0% interest.
Right.
I'm paying more for the same product that Isa has and I have. We both bought a Toyota Camry, yet I have to pay more for it than he does. And he has the money to buy it outright right now and not have any payment at all.
Mhm.
It makes no sense whatsoever. And eventually, one day, it's going to have to change because it can't continue this way without breaking the system.
Right. And
Sorry,
you're
I
right.
didn't mean to go off so much, but it really is unfair to the general population who works really hard to maintain a decent credit score, not behind on any bills, not any judgments against me. A 640 is your average amongst the general working population. That's what most people have, between 620 and 680, somewhere in that zone. And yet we pay the bulk of the interest in this country. We pay the bulk of the fees in this country. It's backwards. The people that
You,
can afford to pay it aren't asked for it. The people that can't afford to pay it are asked to pay twice as much.
right. And you're right. It doesn't make any sense. And again, that's why we do what we do, because we educate our clients on how to improve their credit and how to make the most of it by telling them what it consists of. So we only hit on one aspect, which was the capacity and amount owed, but also payment history. And people don't realize that one missed payment or one late payment can impact your score 100 points. So that's another, keep going down and down and down.
It's the domino effect.
It's yes, you miss one payment and you miss the next payment. You're right. It's going to greatly negatively impact your credit score. So the payment history, also length of credit. And another thing that people don't realize is that when you get a credit card down to a zero balance, what do most people think is the best thing to do?
Most people think the best thing to do is what you just said. Pay off my cards. If you pay off all your credit cards right now to zero balances, your score will go down by 20 to 30 points.
And then they close the account.
In some cases, they will. Some banks don't do that anymore, but some still practice that. But the worst part is, again, by paying off all your credit cards to zero balance, you're going to lose points on your credit score. Utilization was the number one thing. Utilization means using. That's what it equals. If you're not using your credit, then you're dormant. And if you're dormant, you lose points. They want to see
Exactly.
you using your credit. Using your credit means they're making money and they're happy. And if they're happy, they give you some points for that.
Right. And the longer you have an account as well. So
Yes. Yes. History is
the
also
history.
two-pronged. History is two-pronged. It's the history of what you've done with your account and how long you've had your account. Two different things.
Right.
But both factor into history, and history is 20% of your score.
And tell me about how new credit inquiries affect your credit score.
So I had a client, Kim. I had a client come in to see me about 2 years ago. And they've made every payment on time forever and ever. They have about six accounts, and it's spread out over loans and credit and student loans and all the different types of credit. They had a perfect credit profile, but they had been car shopping recently. But the problem is not even that they went car shopping. They went shopping for the car and for its accessories at the same time. Now, here's what ends up happening. You go to dealership A, they show you 2 or 3 vehicles, they run your credit, they run it through 20 different banks to see who's going to give you the best loan. And that first dealership is going to start a chain reaction, because then you go to the second dealership and they do the same thing. You now have 40 inquiries on your credit, some of which will drop off as duplicates. The credit bureaus are not very good at catching this. They should be, because the rule says that they're not supposed to hold against you when you're shopping for any one major purchase, all these inquiries. But if you have 40 inquiries, the most that's going to drop off is 10, and you're still going to have 30. And every hard inquiry can cost you 2 points. That can cost you 60 points off your credit score.
Yep.
It's crazy.
Yeah, it is. And like I've said throughout this whole thing, people don't realize what goes into it. And then one of the last things just to touch on is the type of credit, the difference between revolving loans and installment loans. And you have mortgages, you have car financing. So
you need to evenly spread it out. Although there is one type of loan that is above and beyond all others for your credit, which is, of course, the ultimate loan, the mortgage, the 30-year loan, 15 right. For some of us if we're lucky. But those do count more than anything else, and it's because of 3 things. It's secured, it's an installment loan. You know exactly how much it's going to be, and so it's supposedly, according to the algorithms we spoke of earlier, proves more credit worthiness if you do not miss any payments on a loan where you know in advance what your payment's going to be and it's long term. So that does hold more weight, but that alone won't get you to an 800. To get to an 800 credit score, you're going to need all 4 types of credit worthiness showing on your report. You're going to need revolving accounts, installment accounts, major purchases, car loan, home loan, etc., and smaller purchases. Smaller purchases being Jared's or Diamond Outfitters, or any one of those where you finance something for $3,000 or $4,000 and pay it off. You need to have all 4 things on a well-rounded credit report, all on time without inquiries, to hit that 800 credit, that elusive 800 credit score.
Right, and that's a good explanation of how it's calculated. And then I know a lot of our audience, because a lot of my clients have kids that are recent college graduates. They're just starting out in their financial journey, and they're looking at, how do I build credit? And so you alluded to that with the smaller credit.
There's a lot of good ways to build credit. The best way, though, is slow and steady. Don't expect miracles to happen within 30 days. To get the change within 30 days, even professionals like yourself at repairing credit for people let people know that it's going to take about 6 months for you to see a real change. You'll see changes, little changes in the first 30 to 60 days, but you're not going to see any major changes because it takes a while. The credit bureaus are designed to move slowly.
Mm-hmm.
They're not designed to make rash decisions. People shouldn't go overnight from a 520 to a 750. It doesn't make any sense. What would make you 24 hours later more creditworthy than you were 24 hours before, except possibly winning the lottery? And even that, like I say, is possibly, because for all you know, it could get contested and you may end up owing a lot in back taxes. And, there's a whole host of reasons why winning the lottery may not make you a better credit risk.
Exactly. But again, the banking industry thrives on that situation because I have two college students. Both of my older two boys are in college, and every day one of them is getting an application for a credit card. Every single day.
Okay, so let me explain why that is so that our audience understands the way banks think. A bank looks at a college student as somebody that has to be in debt by the time they graduate. That's how the bank sees them. They want them in the cycle when they graduate. And believe it or not, this is really bad for the college student because it limits their choices when they graduate of where they can take that first job, whether it's going to be in their major or possibly beyond their major. I've seen people who, graduate with a poli-sci degree and immediately become candidates for office, which is above what they wanted to do. They wanted to do analyzing or work for a politician, but they immediately make their run because there happens to be an opening. So you can exceed, but banks literally try to crush you before you graduate. Because if you graduate and you have minimum payments to make on top of your student loans that you might have and any other obligations, rent, food, electricity, phone, internet, etc., all necessities, everything I just named is an absolute necessity. If they can add $300 or $400 onto that, they can force you to take a job that's below what you should go to simply so you can pay your bills.
Mm-hmm.
Now, I'm a big advocate, and I'm not going to get into this. This will be a whole other show one day. But I'm a huge advocate for UBI, Universal Basic Income. It eliminates this problem completely. It's something that's talked about a lot on TED Talks. Please feel free to look it up and listen to some of the experts. Everywhere it's been tried so far, it has been a success. There have been 12 major trials of universal basic income, both in America and across the world. And everywhere where it's been tried, you end up with more productive people, not less. People would think normally, hey, if you just give away free money to someone, they're going to be lazy. They're just going to stay home and watch Judge Judy all day. No, that's not been the case. Actually, what you're doing is freeing them up to do something they enjoy. And if you're working in a field you enjoy working in, you're going to work more hours. You're going to work harder because you like doing it. So
Right.
when you give someone that freedom to say, I don't need to work at McDonald's to pay my rent. I have a degree in X and I want to work in the industry where my degree in X counts, they're more productive.
Mm-hmm.
So it's the exact opposite of what your brain would automatically think.
Right. And that's a great explanation of it. Let me ask a question from Felicia in New York. Why is my credit score so different between Credit Karma, Experian, the bureaus, Credit Sesame? Why do I see such a wide difference? And I get this question all the time because
I'm going to let you answer this. I'll wait until you're completely done before I tell her why on my end. But thank you, Felicia. That's an excellent question.
Can I say affiliate marketing? That these third-party credit companies, when you log into Credit Karma, you'll notice that you have all these offers from all of these banks that you are supposedly pre-approved for. Well, Credit Karma doesn't charge their consumers to just pull their credit report and check their credit report. But where do they get paid? They get paid from all of these third parties that offer these pre-approvals to sign up for these loans. You're approved for a $2,800 loan. You're approved for a $5,000 loan. So
revolving door.
Yep. Exactly. So they would love to put you in a a credit score that makes you want to look for these other offers, take advantage of these offers. So that's already right off the bat, it's not an accurate reading of what your actual credit score is.
Okay, I'm going to take a completely different path here. Credit scores are not just for credit. It's really important to understand that before you understand why Credit Sesame, Credit Karma, Experian, Equifax, TransUnion, Kroll Factual Data, and I can name 100 others that generate a credit score. Credit scores are used for things other than credit all the time. And in fact, you have a low credit score, you're probably paying more for car insurance than the person who has a high credit score, even though your credit score means absolutely nothing to affect your driving. Same goes with your job.
Mhm.
No matter what industry you work in, you may work in an industry that has zero to do with money. You serve ice cream cones on a street corner from a truck. You have nothing to do with finance, but your credit score might affect whether or not they're willing to hire you.
Right.
Which doesn't make a whole lot of sense. It was never meant to be that way. But the industry as a whole, the entire financial industry, and I'm going to get to exactly where you were in just a moment because you're going to see how these bridge together. The entire industry has taken it upon themselves to take something that was never even available to the general public until the late 1980s, early 1990s. No one ever knew what their credit score was. It was impossible for you as an individual or a consumer to find out what your credit score was. It was internal, secret information passed from companies and banks only. Once they allowed the general public a glimpse, the general public said, hey, wait a minute, we want to see more because this is corrupt. And it is corrupt. It's totally corrupt. I mean, nobody can even tell us how to calculate it properly. And if you looked at the Fair Isaac scoring algorithm and you were Sheldon Cooper, or you were Richard Feynman, or you were any incredibly amazing real or fictional genius, you'd be scratching your head like this going, I don't get it.
Right.
So, I mean, only computers can read that out. No human being can read that algorithm and make sense of the math in it. So that being said, here's what you were saying and why I said revolving door. Credit Karma, Credit Wise, Credit Sesame are your three major free places to go get what's called a soft pull credit report. A soft pull credit report is one that does not affect your score. No inquiry is created by viewing it. The reason for that is A, the advertising that Kim spoke of, because what they're doing is they're helping you get your score up so that you can put your score back down, so that you can go get more credit and overextend yourself so that you're back at square one, hence the revolving door. But the other reason behind the soft pull is to hide information. A soft pull is always delayed information. It is not the most current reading of your credit. It is your credit at the last actual general cycle. Now, credit runs on a 32-day cycle, not 30 days like most months, not 31. It runs on a 32-day cycle. So that means that every so often on the 17th of the month, in a given month, that's when the credit cycle is going to end. And you're like, that doesn't make any sense. Shouldn't it be the 1st or the 31st? No, because it's on a 32-day cycle. Every month it gets another day or two into the middle of a month. And you never know when that cycle is going to end. And even if you figure out when it ends once, doesn't mean you'll be right the following month. So it's just better to have a general overall credit healthy. You know how we all try to have healthier diets? Even those of us that say we don't care about dieting, there are times where you just feel like you see a bowl with carrot sticks and another bowl with, potato chips. And you just say to yourself, I really should eat the carrots instead of the potato chips. They're both crunchy. They both taste good.
Yeah.
Same goes for credit. You get to a point where it doesn't matter anymore. But that's a good thing, because when it doesn't matter anymore, it becomes easier to make the good choices instead of the bad choices, because they're equal in your view. And you want to try to make better small choices with your credit. For instance, I have a $5,000 Capital One, and I've been carrying a $3,000 balance on it for years now. And I pay it down and I use it for gas and I use it for my grocery shopping because I don't like carrying cash. I don't want to get robbed. So I just use my Capital One. It's safer and it makes sense. And you're doing not a bad thing. You're showing consistency, which is good, but you're carrying too high a balance and you're not really paying it down because whatever you pay down, you end up charging right back. And you're like, but I have $2,000 of available credit, and that's more than enough for an emergency. That's enough for me to fly from one end of the country to the other and stay a week in a hotel. And that's true. It is enough for that. And it is decent. You're not doing a bad job. But if you could just get that 3 down to 2, your credit score goes up 50 points.
Mhm.
And now Capital One is actually offering to raise your credit limit more because you owe them less. And before you know it, they're going to help you. See, these are the tips and tricks that we talk about. So here's the biggest tip I can give on credit scores for today. And this is for you, Felicia, directly, and everyone who thinks like Felicia thinks. Get your balances down under 33.33%. When you do, it triggers an automatic response from the credit holder if it's a revolving credit account. And that is, hey, they're responsible, raise their limit. And you'll get the offer within 3 months of your getting below 33.33% owed on your card. I guarantee from every single creditor you have that is a revolving credit account, you will get an offer to raise your credit limit. Whether it's Fingerhut, Capital One, Synchrony Bank, whoever it is, this automatic, it's not even a person's decision. The computer's set to do this. Hey, they're under 33.33. Let's raise their credit limit, make them think about spending more money. But don't spend more money. Accept the credit limit increase, but stay just where you were. Because guess what? 6 months down the line, twice the amount of time, you'll get another one and another one. And before you know it, you've built up the kind of credit that when it's time to buy your house or your car, you have so much available credit that they have no choice but to give you the best rate, even if your score is not super high. People forget that if I have 8 credit cards totaling $100,000 worth of available credit, and I'm only using 5,000 of that 100,000, I don't need an auto loan. I could technically just charge the car. Since I don't need the loan companies are going to fight really hard to get me locked into their company. And to do that, they're going to have to entice me with a 2% interest rate or 0% interest for 5 years. You hear about it all the time on approved credit. Well, approved credit doesn't mean your score. It means your profile. And my profile, even though I may only have a 650 to 680, my profile is better than some 800s. And for that reason, I'll get a better offer than they will.
And that's such valuable information, Adam, because people expect that they can go into a dealership with a 720 FICO score and they're automatically approved. They can get whatever they want. And that is not the case because the credit score is just a portion of the entire profile that you talked about.
Exactly. In fact, if you don't mind, Kim, we're going to cut away for 60 seconds to Isa Israel explaining exactly this.
Awesome. Yes, that would be great. Thank you so much, Isa.
Okay, so let's talk about your credit score and what it's made up of. Okay, now Adam and I do this on a day-to-day basis. Kim does this on a day-to-day basis. So for us, these percentages are wired into our brains. But for the average user, something that you need to understand and know. Number one, okay, guys, your credit score is made up of multiple different factors that go into the algorithms that calculate the score. Of those multiple different factors, there are 2 or 3 factors that produce the majority of your score. Number one is your utilization rate. Your utilization rate simply means how much credit were you allowed to have versus how much you have used. So if you have a credit card, for example, with a $10,000 limit and you've used 3,000 of that 10, you are now at a 30% utilization rate. Now, that component of understanding what your utilization rate is responsible for 30 to 35% of your score. Another 30 to 35% of your score pertains to your credit history with those same accounts that you have these utilization rates with. And then another 15% of the score comes from the variety of your credit. two individuals, one with a 750 score, one with a 650 score. The person that has the 750 score might only have three $300 Macy's, JCPenney, and a Target card. That's great. They have a nice score on paper, but they can't get approved for any substantial financing that way because they can only demonstrate that they have control over $900 worth of credit, which is nothing, right? But then the person with the 650 that has a 20% utilization rate across 10 different accounts, plus loans, plus a car payment, plus other things, and they're excellent with keeping track on everything, somebody like that would be ideal for the bank to lend to.
Okay, so there you have it. Isa explaining exactly why what we were talking about isn't the right way to go about it. And let me tell you, he works with people just like you and I do all day long. He is my partner at USFA, and I will bring him in every so often as an expert on these things. But what he just explained there is exactly why you need a whole credit profile, especially when going into mortgages. Now, Isa is and was a licensed mortgage broker. So he knows what goes into getting a mortgage approved. He also was the person who had to sign off on mortgage loans. They have different names in different parts of the country, so I don't want to give anyone a particular name. But it was his job to literally take the stamp and say approved, not approved for mortgage loans. And score wasn't the only thing they looked at. There were people with 750 credit scores that got not approved.
Yeah, it is possible. So it's the whole profile that's looked at. And here's our last question before you and I go back and forth about credit in general. But is it possible to remove negative items from a credit report? Ding, ding, ding.
You want the real answer?
Yep, let's do
No.
the real. Yeah, let's break it down
Okay.
in real life.
The real answer is no, but the actual answer, now real and actual are not the same thing. The actual answer is yes. If that negative item on your credit report is truthful and honest, you're not getting rid of it. You may be able to cover it up and hide it for a short while, but it will be back, and that's a promise. It's a guarantee. It's not a threat. I have the right. Let's pretend for a moment that I am Adam's collection agency. My job is to collect the debt that is owed to whoever. So you borrowed money from whoever in whatever form, on a credit card, a loan. You borrowed money from whoever. You didn't pay it back. Whoever doesn't have time to go chasing after you, they have 300,000 clients. So they come to me and say, here's Mr. Smith. We want our $3,000 from Mr. Smith. And I say, okay. And from that moment on, Mr. Smith is my concern. Getting the $3,000 or negotiating with him on something that will close this account is my only goal. My only goal is close this account and get as much as possible for the person who gave me the debt to collect and move on with my life. In doing so, of course, I'm going to report that this money is owed to all three credit bureaus. Now, there are lots of credit report specialists out there that'll dispute this and say, you have the wrong Mr. Smith. The Mr. Smith you're looking for lives on Jupiter in that big red dot, and you have to go see him there. Or, you have Dave Smith. Well, there's 7,000 Dave Smiths just in that zip code. I know I have the right Dave Smith. Believe me, I do. I have the social security number. It matches. I have the employment information. It matches. And I have a phone number he registered his account with, which is the number I reached him at. So I know I have the right Dave Smith. There's no doubt in my mind. Well, these disputes might win with somebody over at Experian or TransUnion or Equifax or even all three. The odds are very slim, by the way, that if the negative item is real, that all three will remove it. So you might get lucky and it might come off of one, but it'll still be on the other two. And I guarantee you see that all the time, where there's a bad mark on one and it's not on the other two. It's because of these disputes that occur.
Exactly.
Wait 30 days and check again. It'll be back. Because at the end of the 30-day cycle, I'm going to get an automatic email to my collection agency. Does David Smith still owe this debt? And I'm going to type back YES, period, send. And they are going to re-report it even if they took it off last month. The only way to clean up a negative item off your credit report is to either prove that it's incorrect beyond a shadow of a doubt or pay it You don't necessarily have to pay it in full. That's another episode. That's debt relief and debt negotiation and ways to reduce the amount you owe if you're in over your head. There are lots of those, and we'll get into those in another episode, and we'll have some very important people on with us for that are all in that industry and different parts of that industry. But for right now, for credit worthiness purposes only, we're going to make it really clear that yes, you can remove negative items, and there are negative items on 90% of credit reports that don't belong there.
Mhm.
But no, you cannot remove a debt or a negative item that is honest. It will not come off and stay off.
Right, right.
Oh, and a myth to go along with my tip earlier.
Yes.
Here's the worst myth you can be told. And if a credit repair specialist ever says these words to you, tell them they are a liar, tell them they are a scam, and tell them to get into another line of work. You don't have to pay a third party because you don't have a contract with them. This makes no sense whatsoever, but I hear it all the time from people who call themselves credit experts.
Mhm.
So let me explain why this is wrong very briefly, and it's real simple to do. Yes, you did not sign a contract with the collection agency. That is true, but that doesn't matter. See, let's say you rent an apartment in a big building,
Mhm.
and you rent it from ABC Rental Agency. And ABC Rental Agency sells the building to 123 Rental Agency.
Mhm.
Do you just live there rent free for the rest of your life because you don't have a contract with 123 Rental Agency? No, the contract you had with ABC has been bought out by 123, and you now owe 123 the money, even though you never signed a contract with 123. The same thing applies to collections from banks. Yes, you have a Chase card that you didn't pay. And yes, now it's with United Collections Bureau. Guess what? United Collections Bureau has as much, if not more, right to collect that debt than Chase did. And I'll stop there.
Adam, that is excellent information. Again, this is all about informing our audience and giving them the knowledge that they need. And you touched on there are so many credit repair specialists out there that will tell you, "Oh, we'll just write the dispute letters and we'll take care of it." And they may see that it's working. But again, just like my business and just like your business, every person's situation is unique. We have to find out what exactly is on their report. Is it accurate? Is it not accurate? If it's not accurate, we have the steps that can help them repair that.
Well, yeah, I
So,
repeat, 9 out of 10 credit reports have at least one inaccurate piece of information on them.
yes. And
90%.
again, it's not a one size fits all type of solution. We need to sit down and go through their credit report with a fine tooth comb and see what we can do to help fix that. So you're
Right.
absolutely right. Yes and no.
A good credit repair a good credit repair agent knows that repairing credit is a surgical skill. It's not an
Most
umbrella
definitely.
skill. For instance,
Right.
debt negotiation, which I'm an expert at, right?
Mhm.
Negotiating with banks for a better deal for a consumer. That's an umbrella thing. There are certain tactics that work in every situation, other tactics that only work in certain situations. But with credit repair, literal surgical precision is needed to see where the negatives are that can be permanently corrected and where the negatives are that can be temporarily corrected just for enough time for the person to get through what they need to get through,
Mhm.
and then they can afford to do a permanent fix. So there's a lot of surgical precision in credit repair that there isn't in other forms of debt relief.
Mhm. Mhm.
It's a very interesting topic, and one, like I said, when we do our episode on debt relief and debt relief options, we will not be naming any companies because we do not want to get into any legal battles, and nothing posted by me or Kim construes legal advice. We are both not attorneys, and nothing in our podcasts is legal advice. It is personal advice from experts in the field.
Exactly. Thank you for mentioning that. And we've covered so many things about credit, and I think this did exactly what I wanted it to do. Give our viewers information on credit because, like I said, Financial literacy is not taught in school. That's why I wrote a whole book on financial literacy points that should have been taught.
The name of your book. What's the name of your book?
99 financial literacy points you should have been taught. And
It is
I
an excellent read,
always,
by the way. It's an available ebook. Go get it. It's worth it.
on my website. It's on my website. But another thing that I tell my clients, and they kind of look at me like, huh? What does that mean? You need credit before you need credit. Because when you get yourself in a situation and you have nowhere else to turn and you try to get credit, if you don't have any credit, you're not going to get it. So you need credit. If you still don't understand what that means, you need credit to get credit, contact me or Adam. We would be more than happy to look at your unique situation and help you get into a position to have credit before you need it.
Here it is in the simplest terms. And I promise you, you're going to watch Kim laugh. The less you need the money, the more the bank is willing to give you.
Just had this conversation with my son yesterday. Absolutely. Yep.
The less you need the money, the more the bank is going to be willing to give you, because you're less of a risk, because they know you don't need it and can just hand it back to them. And it makes sense in a warped way, but it does make sense that the bank doesn't see you as a risk. Therefore, they're willing to give you more at less of a profit. So as much as I ranted earlier, it does make some sense. However, banks need to relax a little bit and they love to take risks with our money into markets, but they don't want to take risks with our money into us. And that's unfair.
Yep, I think you nailed it. So we're just about out of time. Adam, I want to thank you for your wealth of information. I know that we are doing a great service to our audience and providing them with all the necessary information they need. Also like to thank Isa for popping in and giving us that explanation. He's greatly appreciated as well.
He'll be guesting. He'll be our guest in 2 weeks.
Yes. Yep. I think he'll be our guest.
In between Christmas and New Year's. He's gonna make an appearance. Proud of the fact that we're able to book him, because he has no time. For those that are looking for Kim's website, it's directly above her head, www.cruzcreditconsulting.com. For those who are trying to reach me, USFA, USFinancialAlliance.com. Or you can email me directly at astrum@financialrescuers.com.
And for our audience that has questions that they would like us to cover in our podcast, they can send their emails to questions@cruisinintobetterfinancialfuture.com.
Okay, so let me clarify. That's Cruzin, C-R-U-Z, as in zebra, I-N, into a better financial future.com. Questions at cruisinintobetterfinancialfuture.com is where you can submit questions you want us to answer in our shows, and you can even submit topics you want us to cover. You can email us questions to answer live on our show, or email us topics you want us to cover about credit or finance at questions@cruisinintobetterfinancialfuture.com. That's questions@cruisinintobetterfinancialfuture.com. We look forward to hearing from you. Thanks.
Absolutely. Yep. So thank you very much for listening today, and we will see you next week. Same time, same channel.
Sounds good. Look for us on Anchor, on Apple, on Spotify, and at our new YouTube channel. See you all next week.
Bye-bye.
Bye. Thank you for being a part of Cruising into a Better Financial Future. Don't forget to hit subscribe so you don't miss a future episode. We'll see you next time. Bye.